So good afternoon, everyone, and welcome to the Gowling WLG webinar on the federal government's 75% wage subsidy. My name is Paul Carenza. I'm a tax partner at Gowling, practicing primarily out of the Toronto office. I'm joined today by Laura Gorgiou, a tax partner in our Montreal office, as well as by Nina Gupta, a partner in our employment group based out of the Kitchener-Waterloo office, pardon me. And also by Shannon Wadsworth from our marketing group, whose efforts made this a reality and whose technical expertise at putting this together far surpassed mine. A few notes about the Zoom protocol. The chat function is disabled simply because it's unworkable with the number of people we understand have subscribed to this. We do have the Q&A function enabled. We will attempt to answer questions at the end of the webinar. We have allotted some time for that. We suspect we won't get to all of the questions, but we will address them after the webinar and post a Q&A to our website and likely email each of you a link to that Q&A. The agenda we have for today is as follows. First off, we're going to do an overview of the subsidy program and talk a bit about the gaps and the difficulties that we've identified from speaking with likely many of you. We'll move on to the mechanics of computing the subsidy, including the lack of some detail in accurately computing remuneration in particular instances for particular employees and the manner in which they are compensated. We'll touch on the mechanics of applying for the subsidy based on what we know today. And last but not least, talk a bit about the interaction with other support measures that the government has vis-a-vis employees, principally on the employment law side. So supplementary employment benefit plans, work sharing programs, EI, of course, and the CERB, or the emergency response benefit. So about 2 weeks ago, as you recall, the House of Commons reconvened and passed the COVID-19 Emergency Response Act, which contained about amendments to about 15 to 20 different statutes, including the Income Tax Act. And that's where the earlier announced 10% wage subsidy was contained. So that statute received royal assent on Wednesday, March 25th. And as you'll recall, 2 days later at a press conference on the 27th, it was announced that a broader wage subsidy would be brought in. Following that Friday announcement, we had Minister Morneau release 2 press releases on April 1st. And pretty much that's what we're going to be talking about today. We're not talking about draft legislation, let alone legislation. We're talking about whatever detail was contained in 2 press releases. So it makes it a bit difficult. The policy that's been put forth by the government for this wage subsidy, in our view, is important to keep in mind. The policy is to maintain employment relationships and avoiding layoffs, and to reduce the strain on the EI system and the CERB benefit. And those 2 overriding policy features ought to be kept in mind, certainly have been kept in mind by us in going through what we know to date based on the press releases and announcements. But we hope also kept in mind by the legislature as they are, or the drafters as they're drafting, and the legislature as it comes to adopt. Some of you may have heard that there was a recent announcement just today, again, a press release, a news conference, not a press release. I believe now it's been followed up with a press release. In any event, this, so many people have said this situation is moving so quickly, changing day by day. We're in the same boat with this because we're dealing with press announcements that release details in drabs, sometimes not enough detail, and it leaves us guessing. All to say, I hope the policy goals are followed through. One point about the notion of bailout, and I've heard from some of our clients, multinational clients, that were looking at what they had heard through the news about this subsidy in relation to what they know of the US CARE Act. And I'm not an expert by any stretch on the US legislation, but I understand there are some restrictions on corporate actions that can be taken by a recipient of assistance under those US rules. For instance, they couldn't do a share buyback, they couldn't pay a dividend, do those kinds of things. Based on what we know right now, there are absolutely no ties between taking advantage of this wage subsidy as there are with the US rules. And that makes sense because this wage subsidy is not a grant, it's not a forgivable loan. It, as we'll get to later in this presentation, it represents temporary funding, which is fully taxable to the employer recipient, and eventually tax will be paid on it. So that should, this whole bailout notion should not be a concern. So as I think I said a moment ago, this program is a cash subsidy to employers for 3 separate periods, and the employer will have to apply for the assistance in each of those 3 periods. We have on this slide the setting out of the 3 periods, the claiming period and the reference period and the percentage revenue drop, but we're going to get to the this gating issue of revenue reduction in a couple of slides from now, and that obviously is a key issue for many of our clients, and I'm sure many of you. So just to be clear, this is in addition to the 10% subsidy that was enacted 2 weeks ago, and fairly radically different from that earlier subsidy. That subsidy was a reduction in payroll remittances, whereas the current 75% is a cash inflow from the government. Covered slightly different periods as well. March 18 versus March 15, up to June 19 versus June 6. Generally the same period, but slightly different starting and end dates. It was a much more modest program, of course. The maximums were nowhere near what we anticipate the maximums will be under this one. The maximum was $1,375 per employee and $25,000 per employer under that more modest program. And the biggest difference was who could claim the benefit of it, the eligible employers. Clearly at that point in time, giving the government credit, they had not yet perhaps fully appreciated the extent of the economic impact of the virus. And so that earlier program was limited to, think of them as small businesses. So eligible employers that were individuals, Canadian-controlled private corporations that had a taxable capital under $15 million. So again, fairly small Canadian-controlled private corporations. Nonprofit and charities were eligible. Partnerships comprised of any of the foregoing were eligible. The big one, of course, was any employer in Canada that happened to be part of a multinational group or controlled by a multinational group. They were excluded, full stop. Because the 2 programs are different, and we understand that the draft legislation that we'll be seeing hopefully shortly on the 75% subsidy will make it absolutely clear that employers can claim the benefit of the 2 programs, assuming they are eligible for the 2. Again, no foreign-owned corporations under the earlier, more modest program. And if assistance is claimed by an eligible employer under both, the assistance received under the more modest program is deducted, if you will, from the assistance that can be received under the 75% program. So the eligible employers, in contrast to the more modest program, this one is available to, as it stated, any type of employer in Canada, whether an individual, partnership, corporation, nonprofit, or charity. The key for many of our clients is that foreign ownership is irrelevant. We have this gating issue of the gross revenue reduction, and up until late yesterday, and certainly confirmed in the press conference of Mr. Trudeau today, it had been a 30% revenue reduction month over month, March 2020 to March 2019, February 2020, March, April, May going forward. That was changed through announcement today. We will get to that in a couple of slides, because that gating issue is probably one of the most significant issues of this program. So available to all employers, but it does exclude some. And interestingly, in the two press releases from April 1st, it referred to some of the exclusions differently. In one of them, it said public bodies were excluded. In another one, it said public sector entities were excluded, and went on to describe those as such as municipalities, crown corporations, public universities, colleges, schools, and hospitals. So it's not entirely clear at this point how broad that exclusion is intended to be. It seems clear that they're not going after all tax-exempt entities, or pardon me, excluding all tax-exempt entities, because nonprofits and charities are eligible employers, but the breadth is unclear. And we've had questions about, for instance, band-owned, Indian Aboriginal band-owned entities. We've had entities that are owned by a university, and if the entity is carrying on a business and happens to be owned by a university, should that be excluded? Those details will be interesting to see when they come out. The employer is also intended to make its best efforts to top up the salary of the employee following receipt of the subsidy. We're looking very much forward to the detail on that, because it's not clear what best efforts are, whether it's to the current salary, which may have been reduced, or is it up to the pre-crisis remuneration level? It's not entirely clear based on what's been released to date. Okay, so the revenue reduction, as I said a moment ago, it had been a straight 30%. Today it was confirmed that that is intended to be softened a bit, that rather than looking at March 2019, for instance, as a comparative month, applicants can look to the revenue of January and February of 2020 and compare that to March, compare that to April, compare that to May. In addition, the required reduction level has been reduced from 30% to 15% for the month of March, taking into account that the closures of non-essential services and the closures of most businesses really kicked in the middle of the month. So that's a helpful reduction, and we're looking forward to seeing more details in the draft legislation. The decline in revenues need not be COVID-19 related, which is a good thing, because I'm not sure how one would necessarily identify revenues that are, or revenue reductions that are related to a particular cause. And let's keep in mind that revenue is not profit, it's not income, it's gross revenue. Although it's interesting to note that gross revenue typically does not include inability to collect an account rendered. So bad debts, write-offs, write-downs, they don't appear at this stage to be something that is taken into account. The revenue is to be computed as revenue from a business carried on in Canada. And that's helpful because there are some employers here who operate as a branch of a foreign company that ought to be eligible based, again, on the details that have been released to date. I would not suspect that that would change with the draft legislation, but again, we will have to see. The revenue reduction has to be from arm's length revenue. There's one slide that deals with this in more detail, but that's quite problematic in many situations. The revenues to be computed versus the normal accounting method, said the second press release from April 1st. And it was an interesting choice of words, because it didn't say the normal accounting standard used, but an accounting method. And I'm not sure if the language was intended to mean something else. Again, we'll have to see. The revenue in each part of the comparative periods is to exclude revenue from extraordinary items and revenue from amounts on account of capital. What they're obviously intending to get to is operating revenue, excluding items such as a sale or disposition of a significant business asset. So here are some of the difficulties with this. It's been a very common critique, if you will, from right from April 1st, that the month over month, or even now January, February versus March, works well for retail businesses, quite frankly. Businesses where there's no lag between the labor input and the hiring of the labor that goes into that input and the receipt of payment or the invoicing of the payment. Think of your bar, your restaurant, what have you. It's quite difficult for many others, including manufacturers that will typically have a lag. So you could be, your January, February revenue, for instance, if that's what we're looking at for the comparison, that likely represents production from October, November, December. Your March revenue likely references production from December, January, February. So there's great concern that time lag in and of itself will create difficulties for employers who are in the crunch to actually hit the threshold to be eligible for this. Acquisitions and divestitures over the year. I've had a couple of clients who have either grown or sold off a division. And it's not clear if you sold off a division, and so you're essentially running your business in the normal course at 75 or 70% of what you had last year. Your reduction may have nothing to do with COVID-19, and the reduction doesn't have to be due to COVID-19. But I've had clients suggest that they were concerned whether they should not be adjusting their revenues themselves for fear of after the fact being assessed a penalty for manipulating the system, when they're not manipulating anything at all. Again, it's just an indication of this period over period method of checking how much your business has dropped is a bit of a blunt instrument, and it doesn't address a lot of particular business situations. There's also been some question about whether the reduction should be gauged by business line or division of a particular employer. And based on what we know now, it is to be measured on the entity-wide basis rather than a divisional basis. So some timing issues that affect the decision to rehire or keep your employees. Because of those application periods on the earlier slide, employers are in a bit of a bind here because they don't know whether the wages that they pay, say, over the next 2-3 weeks, will actually be eligible for the subsidy because the measurement period hasn't closed yet. So, I think we have the example here. The wages paid on April 15th would qualify in the April 11 to May 9 window, only if the revenues are down 30% from April 2019 versus perhaps January, February 2020. It's an unknown for a lot of our clients. The revenue reduction again is an issue for new businesses that certainly didn't have a March, April, May 2019 comparable. Maybe this new announcement today of the January and February amounts, perhaps that gives them something to compare to. Otherwise, they were just sitting there not knowing what to do. Similar with the startup that's been operating on seed capital with no sales yet. Not clear if they can show any revenue reduction and would be eligible for anything. Again, these are details that we would hope we would see find their way into the draft legislation to provide some guidance to these employers. Charities and not-for-profits, the April 1st releases from finance indicated that rules were forthcoming, or detail was forthcoming as to how to compute. Today they announced that these entities can choose to exclude or include government funding in the determination of their revenue reduction. This is the arm's length revenues point, and I've spoken with a number of clients who manufacture in Canada goods or components that are sold to other members of a multinational group, either for inclusion in a larger good that is then sold by that non-resident affiliate, or is used by them in their processes. But bottom line is the Canadian entity is in a position where virtually all of its revenue is coming from those non-arm's length sources. So think of manufacturers in a multinational group, R&D performers for a multinational group. It's not clear why they should be excluded. I can see that, I can see that the government may have thought that there were reasons to impose an arm's length rules to avoid, to use the word that I think the Prime Minister used, gaming the system. But in the examples I've just suggested, there's no indication of anything untoward. And to shut these employers out of the subsidy is inexplicable in my view. So we're hopeful that this is a detail that perhaps we'll see in a future press release, and ultimately, hopefully, we'll see it in the draft legislation. Central Paymasters is another similar example. There are lots of corporate groups where essentially all of the workforce is technically employed in one entity, and that entity then sells the labor, if you will, to other members of the same corporate group. In that case, the same concerns and the same absence of untoward conduct are present. So we would hope that that would be addressed too. At this point, I'm going to cede to Laura, who's going to walk us through some of the mechanics of the subsidy.
Thank you, Paul. Next slide, please. Okay, perfect. So the mechanics of the subsidy are different depending on whether the employee is dealing at arm's length or not with his employer. So whether the criteria is the employee somehow related to the employer. And the test that we apply is the test under the Income Tax Act. So things like family relations or corporations controlled by the other corporation would create non-arm's length relationships. In this case, if the employee was the shareholder of the corporation, then clearly it would not be an arm's length relationship. And so for the arm's length employee, the employee who is cannot control how much remuneration is paid, the formula is quite flexible. And what it says is that as a baseline, the employee, the wage subsidy that can be claimed on the employee's salary is at least 75% of the pre-crisis remuneration up to the cap of $8.47 a week. And so therefore, if the employee is paid less than that during the period, it's possible that the wage subsidy is more than 75% of what is paid. I'm going to just walk you through the formula. It's a little bit more mathematical, but at the end of the day, that's the result. So the formula says we must look at the greater of two figures, two numbers. One is 75% of how much we're paying that person now. And the other figure is calculated based on the lesser of two amounts. One of the amounts is the 75% of pre-crisis remuneration, which is not a defined term. And the other amount is the full amount that we're paying that person right now, up to $847. So that means if we pay them less, we may be able to claim up to the full amount we pay them. And if for some reason we want to pay more, and where that could be a factor is where we want to maximize the wage subsidy we claim, and they are not being paid a high enough salary to reach that level, it is actually possible to pay more than the pre-crisis remuneration, in which case you would claim 75% of how much you're paying now. As I mentioned, pre-crisis remuneration is not defined. So you query whether you should be taking the annual salary and dividing it by the number of months or weeks in the year, whether you should be looking at the salary the month before the person was, or the crisis began and the person may have been laid off. So that's definitely a question that remains. And so as I mentioned, it is possible that you can get back the full amount that you're paying them now if it's less than what it was before. And we'll run through some examples to help you understand that. But if you are able to maximize the amount of subsidy claimed per employee, the total possible available is $10,164 per employee. There is no cap for the employer. And in the case of what we call our non-arm's length relationships between the employee and the employer. So the example of the owner-manager corporation, where the owner, the shareholder, was also an employee of his corporation, the test is a lot more stringent because obviously as a shareholder, as a controlling shareholder, he is able to determine, or she is able to determine how much remuneration she or he gets in that period. And so there's no ability to pay more than before the crisis began and claim any kind of subsidy. It's capped at 75% of pre-crisis remuneration, or if you pay less than that now, it would be that amount or the amount of actually paid right now up to $847, whichever of the two is less. What does this mean in practice? If a shareholder was not paying himself any salary before and was only choosing to pay out dividends, it's not possible to switch to being an employee now and try to benefit from the subsidy. That's not available. And obviously there's no way to bump up the amount that was previously paid in order to benefit from the full amount of the subsidy. So here's an example to help you put into numbers the formula that we just went through. If your employee was at an annual salary of $50,000 a year, and we're assuming they're using that method of calculating pre-crisis remuneration, that would mean that they were making $960 a week before the crisis began. And if you continue to pay them that amount, let's say you continue to have folks on your payroll and you want, with respect to what you're paying them, to claim the subsidy, the way you would calculate how much you're able to claim per week would be using the formula, and it would say, well, what is 75% of this amount, 962, and is it less than 847 a week? So we see here at number one that 75% of 962 is $722. So that's less than the cap, and you're able to claim the full amount. If you have to reduce how much you pay them now because of constraints, financial constraints, let's say you reduce it by 20%. So you're only paying them 80% of their previous salary, $769 a week right now. You see in the bottom half of that example that 75% of $769 is $577 a week. But as I said, you are able to claim more if you reduce as compared to what you're paying before. So because of that, if we look at the second part of the formula, which says how much are you paying now? $769, and what's 75% of how much you were paying before? Well, 75% of how much I was paying before is $722, and I'm able to claim the higher of that, or 75% of how much I'm paying now. So in numbers terms, I'm able to claim $722 when I pay $769 a week to this person. So you see that it's a lot more than 75% of what you are paying now, because that amount has gone down as compared to before. Now, obviously, this is an example in the unrelated or arm's length scenario where it is not an owner-managed business. It's really an employee at arm's length with his employer. And what about scenarios where the employee is paid more than the maximum of the subsidy. The subsidy is calculated or assumes $58,700 of income a year. So in a scenario where the employee is paid more than that and continues to be paid more than that after the crisis begins, the subsidy is capped at $847 a week. So we see in the top part that an employee at $100,000 would be making $1,923 a week, but you could only claim $847 as against that wage in that week. But even if you were reduced 20% to $80,000, the cap would still be $847. And then the next example is the one on which the modeling was done for the program, which is a salary of $58,700 a week, 75% of which is $44,000. So in that case, the employee, if he were continued to be paid what he was paid before, the $58,700, would be making $1,129 a week. And in that case, the maximum that could be claimed as a subsidy would be $847. If instead the employee's wages were reduced by 20% to $903 because of the crisis, on the $903, it's not just 75% that can be claimed back, which would have been only $677 in the week. Rather, because of the formula, the employer is able to claim the full $847 cap of the subsidy for that employee. So you see, you're paying $903, but you're able to claim back $847. So quite almost 100%. So the question is obviously what is an eligible remuneration? And the definitions that were been provided, and as Paul was saying, this is all very high level. And there's no draft legislation yet to look at. So we are just looking at the documentation published on the finance website to date. But they do mention that all salary, wages, and other remuneration would apply with certain exclusions. And so they say this is an amount on which income tax withholdings would be required. So the normal income tax withholdings of an employer vis-a-vis his employees' wages. And exclusions are made for things like severance pay, stock option benefits, non-cash benefits, for example, car benefits, phone benefits, and so on. But also, and this is an important one that is quite essential, and I've seen some questions come up already in the Q&A on this. There is a mention that for any period in which the employee could have, doesn't mean they did, it doesn't mean there's no tracking to what the employee did, but could have claimed the CERB, the Canada Emergency Response Benefit, for that 4-week period in which that person could have received the payment, there cannot be also a claim for the CEWS, the wage subsidy. So as an example, the employee must be laid off for 14 days in order to qualify for the CERB. After the 14 days, they are able to apply and receive the CERB payment. If the employer on the 15th day of that period calls back the employee and starts to pay them, so for that four-week period, 2 weeks the employee is laid off, and 2 weeks he's now back on the payroll, the employer cannot claim the wage subsidy for those last 2 weeks, even though he's paying the remuneration because of this exception. So it's quite unclear what is the intended result, because as Paul mentioned, the purpose of this is to get people off CRB and back on the payroll and continuing that employment relationship. And obviously this discourages an employer from doing that. So we're watching this closely to see whether there will be more details or a solution to that. And another issue that is important is what happens with periodic payments that are dependent on performance, like bonuses or commissions. And that's quite important because it determines how much of the subsidy can be claimed. And if I can just go to the next slide for a minute, I want to show you an example so you see what I mean. Imagine if you had an employee which had a base salary of $40,000 a year, But last year, we know that they were able to earn another $60,000 on commission. So on their income tax return and under T4s, they're showing $100,000 of employment income. Now you keep them on payroll, but they're no longer able to make sales because of the restrictions. And so they're being paid their base salary of $40,000 a year. Are you able, vis-a-vis that employee, to claim back more subsidy because you're paying them less than last year, or are you only able to claim back 75% of what you're paying them? So right now at 40,000, you would be paying them $769 a week. And at 75% of that, it would mean that you would only claim $577 if the government does not accept to look at the commissions paid last year. If that commission could also be included in pre-crisis remuneration, if we look on the right side of the table here, we see that you could actually claim $769 as a wage subsidy. So if you're looking at this and recognizing there's some uncertainty, you can at least already conclude that you may claim 577, but perhaps depending on how things are interpreted and how the legislation looks once it is published, perhaps there may be a possibility to claim more. So an uncertain point, but one that's important at this junction. And if I could just go back to the previous slide for a second, please. I wanted to wrap up some more thoughts on the eligible remuneration. It's important to note that although there is a limit on how much you can claim per employee, there is no overall envelope that you have to worry about. So as long as the employee qualifies and you qualify with respect to the reduction in gross revenue, you are able to claim it on all your employees. Also, when you are not, when it's an arm's length employee, if you're looking to hire somebody new, you are able to claim on that person's wages as well. So there's no restriction in adding staff right now. However, if you are a sole proprietor carrying on your own business, you do not qualify for this wage subsidy. So the only option available to you is the CERB. And another point that I think is important as you're modeling out the cash flow impact to you is that you are actually hiring back, if they're not already on the payroll, hiring back employees onto your payroll. It doesn't mean there's any requirement that they have to be performing tasks of their employment, but there is a same treatment as you would have if you were paying them regular remuneration. So that means that the regular payroll withholdings will apply, but also your employer contributions to things like employment insurance and Canada pension plan will also apply, and that needs to be taken into account when you're modeling the cash impact to you of this program. And there's some questions about how qualification happens. What we've seen as an announcement is that in about 6 weeks, 3 to 6 weeks, there will be a portal on the CRA My Business account through which the employer can apply for the subsidy. And so that means that you must finance the remuneration and pay the remuneration in the qualifying periods that Paul showed at the beginning in order to be able to apply. And the application is done each month. So for the period of March 15 to April 11, you will apply, and then again for April to May and May to June. So there's 3 different applications. And there's no, how can I say, the qualification is meeting the conditions, but there is no approval probably that will happen. It will probably be a question of audit after the fact. And so the requirements are that you pay first, you then apply, you certify that you meet the conditions. There should be a payment in more than 6 weeks from the announcement. And then you may expect that you will be audited on the claim that you have made. And the amount is taxable. So as all government assistance, when you are paid the subsidy, you will have to include it in your income for the year. Now this shouldn't impact your taxable income because you also have an offsetting deduction of the remuneration you actually paid the employees. And in most cases, you paid more than you're able to claim back. So you should still have, you shouldn't have a tax to pay, income tax to pay. But if you're claiming other types of tax credits, for example, research and development credits, then the amount of the wage subsidy will reduce the eligible expenses on which you can claim that subsidy. So that's an important point to keep in mind when you're calculating how much shreds you might be able to claim in the year. And there's been quite a bit of commentary when this was announced about making sure that there is compliance and that there will be some sort of penalties applied. There isn't a lot of detail of what form they will take. But we would expect that if it's shown after the fact and admitting that a lot of times you will not be able to know at the time that amounts or remuneration is paid, whether there is actually the 30% reduction or the 15% reduction in gross revenues, except but by forecasting it out. So if it's shown after the fact when there is an audit that the conditions were not met, we would expect at the minimum that there would be a requirement to pay back the subsidy. And of course, in the case of fraudulent claims, there could be specific anti-abuse rules in this case, and perhaps even offenses, which to make a distinction, a penalty is administrative, but if an offense is committed, then there could be fines or even imprisonment. But it's all very high level, and we saw the Prime Minister speaking at length about this, but also the Finance Minister, but they didn't give details about what exactly would be the forms of this. So I think would be something to follow in the draft legislation. So things to do right now, one step to making sure that you will get your refund, or not the refund, but the wage subsidy as quickly as possible, is to make sure you're set up with the CRA for direct deposit, to gather together the information to demonstrate the 15 and 30% reduction in gross revenues. And any documentation to support the pre-crisis remuneration paid. And also, and Nina will speak more towards this, but consider whether this is the best program given the other options available to you, and also whether you can integrate this program with others. And there is one that was for Quebec participants or employers with employees in Quebec could be of interest, was announced by the Quebec government on Monday afternoon, which is called the CAPME. This is a training program effectively allowing you to get back up to $25 an hour of salary paid to an employee that is in training. So if you're doing online training to get them up to speed on language skills, AI, technology, anything to do with their specific profession, or any other kind of skills, it might be possible to get back up to $25 of an hour of the wages you pay them. And that program can be matched with the CEWS, this wage subsidy that we've just discussed, so that if you get 75% of the remuneration refunded through the CEWS, you could get the other 25 if you're spending it on training, if they're spending the time training, refunded through the Quebec program. So that's something to keep in mind. Now I'm going to turn it over to Nina, who can walk us through some of the other programs and the interactions.
So a couple of things that people have asked me about, including employers. Hello, everyone, is employment insurance. And this is not, of course, something that helps the employee but does help your employees. And so a couple of things that you need to know is people are talking a lot about CERB and EI, and there are a lot of people out there who are surprised that they're getting less from CERB than they would from EI. And just a couple of things: if they are already on EI for some reason, their current claim continues. If there is a EI claim due to pregnancy, parental compassionate care, not because of lack of work, regular EI applies. If they were laid off or terminated before March 15th, that's only regular EI. But if they are laid off or terminated as of March 15th due to lack of work, COVID related, they are eligible for the CERB benefit first. That's 16 weeks. And then if they're still unemployed, they go on to EI. Next slide. So the CERB benefit, and actually people have already received their first CERB benefit checks deposited directly. So the portal opened up on Monday and people have already received monies on Wednesday. So it's pretty fast. And it's for people who've had no income in a 14 out of 28 day cycle. There's some suggestion that that might be relaxed to permit some work, 10 hours of work per week. We all know it's $500 a week. Some people will win on that because it will be better than their EI or even better than what they were earning before. And some people will lose. The best thing to know is this does not reduce EI benefits. And the biggest problem from an employer's perspective is that if they had the ability to top up unemployment, they probably could have the ability to top up CERB payments. But unfortunately, as the legislation now stands, you are not able to top up CERB payments. There's suggestions that that's being reviewed at a high level, but right now the legislation is not sympathetic to an employer who's trying to help out an employee. CERB payments are definitely taxable. Even if there's no withholdings taken on at source, they are taxable amounts. And there is no suggestion of clawback. So if somebody earns lots and lots of money in 2020 despite the pandemic, there's no suggestion that CERB payments will actually be clawed back. So that's a good thing about the CERB structure. Next slide, please. We received a couple of questions about how work sharing might work with the business wage subsidy. And up until today, our understanding is that you can apply for work sharing. And work sharing is an EI funded mechanism by which employees pool together in a unit. They share the work that's available, and EI essentially is paid for the hours they are not working on a prorated basis. Work sharing itself has been simplified significantly. And just a word of caution, not to be too influenced by what you are reading on the web. Go straight to the form because the form has been updated for COVID-19. And what's really interesting is that there is a COVID-19 work share rapid response team. So they are committed to try to get approval within 10 days. There's no waiting period. So those of you who've done it before may have seen a 30-day waiting period. There's no requirement to prove a downturn, no requirement to submit the written recovery plan, although you may be asked for it later. So you can have EI work sharing. And as far as we know as of today, you can use the business wage subsidy to help offset the actual wages that you are paying during the work sharing period. Next slide. The problem with EI payments that are provided to your employees is that it's subject to clawback. And the clawback starts to be triggered if an employee earns $67,750 in 2020 calendar year from all employment sources. However, there are lots of people for whom work sharing would be a good option for low and middle income earners, and we encourage you to consider using work sharing if that's appropriate for you. And the government officers are really committed to helping you through the work share application process. Next slide. I've spoken briefly about supplementary unemployment benefits, and so it's essentially a way to get approval to pay your employee when they're unemployed without causing a reduction in the EI benefits otherwise that they would earn. It's less, quite frankly, helpful given the 16 weeks of CERB payments, but I give you the information as to where to apply for the sub. And I continue to hope that there will be some changes to the CERB regulations that would allow us to use a sub-like vehicle on on CERB payments being paid by the government. Next slide, please. So I just wanted to give a warning because we talk about all these government subsidies and assistance, which is great. However, employees who have suffered a loss of income can still go to a lawyer, a plaintiff side lawyer, and argue that a layoff or a reduction in pay or a change in duties amounts to a form of breach of contract or constructive dismissal, and seek damages for the period of time that they earned less money than they were expecting. I don't know how the courts are going to react. I know that courts have historically in Ontario been quite pro-employee and anti-employer, sensing an imbalance between employer and employee. I'm wondering if the courts, which have largely shut down themselves and laid off some staff, will be a little bit more sympathetic to employers' plight in face of the fact that there is this tremendous worldwide pandemic out of the control of any particular employer. So we will see how those employment law issues will pan out. I just want to give you a quick alert that those still remain live. And then one other thing, we haven't talked about unionized workers at all, but quite frankly, we really should, because if you're going to do anything, whether it's apply for the business wage subsidy or the like, you have to work with your union rep. Next slide. So I know we got a lot of questions on our Q&A app, and I volunteered to read them because I went on last, and I am going to shout out the questions, and hopefully one of Laura or Paul will chime in. And one of the questions was, you know, about that, the Prime Minister is sort of saying you have to pay the balance of the 25%, and is that really voluntary? And what if you can't pay it? And I'm wondering, Paul, if you want to address that and then have Laura chime in.
I think the only way to make sense out of that stated requirement is that they must be referring to pre-crisis remuneration, because otherwise it makes no sense to me. Because if you're paying, you know, $1,000 and you're entitled to a $750 subsidy, you're only entitled to the $750 because you're paying $1,000. You're paying that extra 25%. So I think the only way it makes sense is if the reference to best efforts to top up is a reference to the pre-crisis remuneration. That's my take at this point, but waiting on detail.
And Laura, do you have anything else to add?
I think that's right, and we saw some examples in going through that it's possible that you would get the full amount of what you pay back in terms of subsidy. Obviously, that does not that's not necessarily the desired. They would prefer that the person be paid their full pre-crisis remuneration, where the top-up would be coming in.
Okay, and so we're at 3:58, and we did commit to end at 4. So we've got probably 100 questions here. We're going to try to look at them and see if we have some themes that we can deal with in sort of an agglomerated way. So it's not specific legal advice, it's not specific answers for your company's positions, but just sort of themes that have emerged. One question I do want to answer is, you know, if you've had to do some partial layoffs, but you're still working with, let's say, 50% of your workforce, can you still claim the wage subsidy? You can absolutely claim the wage subsidy based on the actual wages or remuneration you are paying. So obviously the people you're laid off and haven't paid any money to, there's no subsidy for that there because you have not paid wages to them. But for the balance of the people you have kept, you can absolutely claim the wage subsidy. And then the one other question I wanted to ask is you know, some employers are contemplating calling back and retroactively paying some employees and claiming the wage subsidy, which is better than CERB, but these people have already applied for CERB or received CERB. Laura, do you know if there's a way of dealing with that situation? Is the employer just disentitled from claiming the wage subsidy for that period of time, or what happens?
Well, certainly based on what we have now as information, there is a risk. Now, we may have more clarity, and we hope to have more clarity in the coming days. And remember, the application will only be available in 6 weeks from the announcement. So we're maybe 5 weeks away from the application being live. But certainly there's a risk for the 2-week period that the person overlaps with the CERB qualification that they may not be qualifying for the subsidy on those 2 weeks. After that, though, they should be qualifying if they meet the other conditions.
Okay. All right.
I just want to make, Nina, one more comment, because I did go through and we're glad we have so many questions. It means that what we're saying is resonating with folks, and we will try to answer them all as best we can in a agglomerated way in the Q&A that we publish afterwards. But there is something that's important that we were explaining earlier, which is that this is really a paying of wages, and then later the employer claims the subsidy. This is not a way that the employer on behalf of employees is trying to get funding into the employee's hands. You continue to pay people. They may or may not be able to work for you, because obviously if the store is closed or the factory is closed, they cannot be working for you in terms of physically rendering any kind of employment services. But you pay them now like before, maybe at a reduced rate, and then you as employer get to compensate yourself with this subsidy after the fact. So I think that's really important in terms of the mechanism.
Yes, and that has been the concern for many businesses. There's a question, and we're going to end with that one, which is, you know, the government says 6 wages can be sped up. Prime Minister Trudeau was pretty hopeful that they might be able to get that portal going as soon as 3 weeks. But we don't know anything more than what you read in the papers or hear on the newspapers. Well, thank you for joining us. Thank you to Paul Carenza, Laura, to the entire marketing team that works invisibly in the background to put these together. Thanks for all of you. I truly believe that together we will flatten that curve and we will get through this together. So thank you for joining us. One last thing, if you want to receive our COVID-19 updates, please go on our site to register. Because of the CASL regulations, it is much easier for us if you have actually indicated that you want to receive our COVID-19 updates for us to keep you apprised. Thank you and have a great afternoon.
Thank you.
Thank you.